Welcome everyone to the Elite Weekly Webinar. I'm Riz, going to be hosting today. Chris isn't here for today, but I am glad to be able to be on and talk about markets and my thoughts around everything that's going on. Because boy, there's been a lot going on, not just the last week, but obviously over the last few weeks. So this is the S&P 500. These are the lines here that I've had from before a few weeks back, in fact, and I haven't added anything, I haven't touched anything. You can see the 200-day moving average here in the red line and the 50-day moving average in the green line. We had a really bad Friday, but Thursday kind of started off with the sell-off here due to James Bullard, I believe is his name, who said, maybe we should have a 50 basis point hike or even a 1% rate hike to really kick things off. And obviously the market didn't really like that. But the big news was Friday. We had a decent start to the day on Friday with the market opening red, but then recovering quite a bit. You can see with this wick here that goes all the way up here near 45.30. So that tells us it's been as high as here. We had a little bit of recovery, in fact. And I'm pretty certain we would have had a pretty decent day, maybe a flat or slightly red, but nothing like what we saw, in the last few hours. Because the reason what we saw this big sell-off was news came out, I think maybe around 1 p.m. Eastern time, that, Russia may maybe start their attack or invasion of Ukraine, this coming week sometime. And that just sent the market into a spiral. And we saw that live, right? We saw that happen in front of our eyes. At that point, it was just a massive news storm, headlines popping everywhere from Bloomberg to you name it. And whether there's any substance to that, whether there's any truth to it, remains to be seen. Honestly, there is no... the White House, the administration, the defense secretary or chief or whatever, has said that there's potentially, a chance that Russia could attack, but we don't know based on what exact information they're going off of, and we never will, right? We never will know because that's all classified and top secret and whatnot. But ultimately, that news breaking caused the markets to really, for lack of a better word, kind of react and panic. Because I will say, and I'm not trying to say that, war is good, but ultimately in the past, 30 years or so, war has actually not been too bad of a catalyst for the economy. Hasn't been too bad of a catalyst for the markets. Okay, now that's me saying over the last 30 years. Is war a good thing? Absolutely not. From a humanistic standpoint, but in terms of markets, it's not the end all be all. The big question mark here is, if Russia and Ukraine go at it, and no one else does anything, well, okay, it's not going to impact North America or even most of Europe too much immediately. But the fear is, because NATO and a whole bunch of other countries involved in NATO, technically it's an alliance, and if something happens to one country, everyone can get involved, and obviously, God forbid, they do. If everyone gets involved, well, then we could have a big standoff on our hands, the likes of which we haven't seen for many years. So the fear is that, plus obviously everyone involved, Russia and U.S. and pretty much almost all of the NATO countries have nuclear capability. So that's the kind of worry and kind of jitters that you see going around, right? Obviously, it goes without saying that nuclear war is not good for anyone. I don't care if you're Russian, Chinese, American. It doesn't really matter, whether you're from the north, south, east, west, doesn't matter. It's not good for anyone, period, full stop. So really, this is a bit concerning. This is a bit concerning. Am I personally losing sleep over it? No. Um, I've lost more sleep over the last 2 years over everything to do with COVID and all that, all the intricacies around that than this. But um, I hope obviously everything goes, works itself out. How that happens or if that happens remains to be seen. But going back to markets, these levels, you can see for yourself how crucial these levels are. I can't tell the future, and I'm not going to say, you know, that I have any ability to predict the future, or see the future, but I mean, it goes without saying, like this line was already here many weeks ago, and you could see, just look at this for yourself. Like, I mean, I don't even know. Sometimes I look back and I just kind of scare myself. But you know, it the market bounced off this level that I had here, 4,300, multiple times, and to me, it's just uncanny because I had drawn this quite some time back. And then obviously, not only did it bounce off from it just went up and passed another level that I had near 4,400, and we haven't seen that level again since Friday, where it touched the 4,400 and then picked it up a little. You can see this as I zoom in here with that little tail, that wick, right? And look at that. Again, this line, I assure you, was drawn a few weeks back, 4,400. It's been a key level. I've been talking about it. You're in the elite membership as you watch this live. The 4,400 level is nothing surprising to you. I've mentioned it so many times. And you can see it visually here. And look at it. Look at the market just kind of hold that, right? Bounce right from it. So in theory, it looks, oh, Riz, it's so simple. 4,400, 4,300, 4,500, just key levels. Yeah, but not quite. Knowing when and where to have these key levels and when they apply and when they don't is the actual important part. And the analogy I can give you is like, imagine if, you have like a plumber come in and you call in a plumber, and let's say, the plumber charges a lot of money for making the trip down, and obviously charging you for labor and time for fixing something. Let's say you need to fix like a pipe that's leaking or something, and he comes in, it's like a 2-minute job, and then he gives you the bill for like $200, and you're like, what the fuck? You just came here and just took a hammer at something, and you're quoting me 200. It took you 2 minutes, and the plumber essentially goes, well, you're not paying me $200 for the 2 minutes of work. You're paying me $200 for the years and years of experience and know-how, so that I know how to do the job in 2 minutes, so that I know exactly where to hammer and where, I should use the wrench and where I shouldn't, and where I should hammer and not to hammer because I don't break the pipe, right? So that's the kind of analogy I can give you. It all looks easy, and I assure you it's not rocket science, but you could see this time and time again, and it's really a sweet science. So for those of you that maybe think, well, Riz, I mean, it's so easy, just draw lines every 100 points in the SPX. I wish, right? But either way, I've had these kinds of areas here for us. Keep an eye on the 4,400 level I mentioned before. If we go below Monday, I mean, we'll have to see tomorrow, Sunday, after 6 p.m. Eastern time, what futures are like. But even that we know is not too indicative. We've seen markets turn around on a dime. So very important to keep an eye on the 4,400 level. If we go below, we could be in for a little bit of pain. Obviously, if you've been paying attention, I do have some UVXY calls as insurance, as a hedge. Right? Am I looking to hopefully make money off of them? No, either just as a hedge. They'll kind of blunt a little bit of the pain for my long positions, for my holdings, if we do see a continuation lower. If we see a recovery, great, I'll gladly accept that and have those calls essentially go in the dumpster, because that's like insurance, right? Insurance premium going away, that's fine. At least the account's doing well total. So keep an eye on that. If we see a pickup, the next area we want to keep an eye is the 44.50, which also subsequently is right at the 200-day moving average. All right, so a lot of talk. Hopefully this resonates with you. It makes a little bit more sense in terms of what happened, where we are right now, in terms of key technical levels, and of course, broadly speaking, from the Russia, Ukraine, and the world really kind of narrative there, where are we in for some conflict, for some geographical conflict. It remains to be seen. I hope not. I hope, I said this to people that I know. I said, we just, it seems like recently just got past this global pandemic that lasted, nearly 2 years, so on and so forth. Many deaths and obviously a lot of pain and uncertainty that humanity has to go through over the last 2 years. And the last thing we want is another conflict made of our own hands. By our own hands, I mean as human beings. This is not what we need. But hey, it is the situation. Moving on, I'm going to bring up here, I have the individual market sectors. Okay, we'll do year to date. We're nearly a month and a half into 2022 already, so we'll do year to date, see what's doing well and what isn't. So right off the bat, energy continues. We'll touch on oil specifically in a bit, but energy continues to run, and it's no surprise because we've seen traditional legacy energy, which is oil, do really well the last week, and you can see this tick up here, right? What hasn't been doing so well is everything else. Above this white line is XLF. This is the financials. Financials have done well. We're amongst oil or energy, I should say, of the two sectors that have been positive on the year to date. But that too has kind of pulled back a little bit. Everything else below this white line is in the negative, in the red. XLU, utilities, down 5%, 5.5% nearly year to date. XLV is pharmaceuticals and healthcare. So that's down nearly about 6.5% year to date. And obviously the SPY, S&P 500 ETF, is down just close to 8% year to date. And last but not least, real estate is XLRE and XLK is the tech sector, and both of them down near about 11.5%. So very, very interesting. Not a good start to the year, obviously, but you know what? We've been through worse, I think, in terms of market volatility. Obviously, in terms of March, April 2020, right? So that's the sector kind of movement going on for the last month and a half nearly. All right. Moving into different asset classes, I have here, I know Chris doesn't, but I have here on the top left, I have the 10-year Treasury bond yield. Okay. And this is good that I have it up because it's pretty relevant here. The 10-year Treasury, okay, bond yield is essentially kind of like the floor for interest rates if you want to think about it. And I can tell you just from this chart, if you're not able to see clearly, it's at nearly 1.96%. This is the yield. So nearly 2% yield. And that is just a tick above a 2-year high. So in the last 2 years, Treasury yields are at the highest they've been in the last 2 years. Okay, just before 2020. So think about that. It seems like a different world, right? End of 2019 is where we're at right now, as you can see. So what does this mean? Interest rates obviously are a big talking point. And the Treasury, 10-year Treasury yield, essentially all Treasury bonds, but specifically the 10-year yield, is a good indication of kind of like a floor for interest rates. So if the bond yields are going up, that means bond prices are coming down. But that is as a result of the bond market reacting to potential rate hikes, right? And that's what we're seeing. If rates go up, we see, 10-year bond yield, Treasury yields go up too, right? So what does that mean? That means it's getting more expensive to borrow, and not just for companies, not just for multi-trillion-dollar corporations, but you, me, I don't have any debts, but you, me, everyone else, as a retail trader, as an individual, as a consumer, as a customer, as a business owner, as an employee, whatever, it doesn't matter. Things start getting more costly in terms of borrowing, in terms of purchasing on credit all across the board, whether it's, and I've said this before, I don't want to dive repeat myself too much, but essentially all credit borrowing costs go up, right, as interest rates go up. So that's the kind of environment we're in, and this isn't unexpected. This is something we were expecting to happen. It's just happening sooner. Why is it happening sooner? Because inflation has been completely out of control. It doesn't surprise me. It shouldn't come as a surprise to anyone by now, but hey, here we are of the central bank and the economists and all these fucking idiots at the wheel just sleeping. Hey, Jesus, hold the wheel. These idiots just clearly didn't know what they're going on about, and I could go on a tirade. Give me a thumbs up if I should go on a tirade in the chat room. Hit the chat. But really, I could go on a tirade about these central bankers. Look at the thumbs up coming in. You guys love it when I get angry, I guess. Oh my god, I haven't seen this many thumbs up in a long time. Yeah, but these overpaid, ancient central bankers, these ridiculous, idiotic economists. If I saw them, I wouldn't even want to shake their hand. This should be such a fucking waste of energy for me. Like, it just blows my mind. It blows my mind, and I don't even get in. I won't even. And Lloyd says, include politicians too. Yes, Lloyd, absolutely. And I don't want to get too polarized here, too, I would say, individualistic in terms of how I see things. I want to give people the opportunity to think for themselves, obviously. But personally, for me, I have a massive disdain for these economists and all these high and mighty individuals in their little glass ceiling, these little areas where they just feel like they can't be wrong, and they're just, all high and mighty self-righteous. They don't see the reality that, someone like you or me could see. And it's just unfortunate, really. And this is the example. This is what happens when central bankers, when Wall Street elites, when politicians, they get too caught up in drinking their own Kool-Aid, and they think they're irrefutable. They think they can't be wrong. They think they know what they're doing. They don't. If there's one lesson you can take from this video, this webinar, whether you're watching live or whether you're watching it after the fact, is that the people you think, that could be billionaires, they could be politicians, they could be people who lead and run countries, they could be people who lead and run our institutions, does not mean they know what they're doing. It's not a guarantee. Yes, I'm sure some do, but I can assure you the vast majority don't necessarily know what they're doing. Okay? To think otherwise is being naive and simply fooling ourselves into thinking that we have some false sense of security. That we have some false sense of security that those above us, those who are in high finance or higher levels of society, or who rub shoulders amongst the elites, so to speak, of, we're the elite membership when it comes to trading, but the people that are so high and mighty and essentially they're just unwilling to see things for what they are, well, that's what we're contending against. Those are the people that we have to really look at and hold accountable. And I don't care if it's Democrats or Republicans or this or that. I just don't care. I don't see red and blue. I don't see black and white. I don't see things in that light. All right? How's that for a rhyme? Okay. All right. So ultimately, we have to hold these people accountable. And here we are. If your grocery bill is up $100, $200 a week, whatever, obviously your gas, filling up your car, if you drive a combustion engine, has obviously gone up significantly. But even something like your grocery bill has gone up. Even something like, being able to buy certain items and products for yourself that have now gone up, or maybe they're not even able to buy them because they're just not available due to the supply chain issues, due to the materials issues. Well, you got to ask yourself, part of it, not all of it, but part of it has to do with those that are in power, that have the ability to make the decisions. They just couldn't make the right decisions at the right time. Yeah, part of it looks easy. I assure you, it's not easy. But you would think with all the money that they get paid, all the resources that they have, they would at least get it mostly right. But no, no, that's, I guess, too much to ask nowadays, right? So here we are with 7.5% inflation. I assure you, if you are younger than 40 years old, if you are like me, younger than 40, I'm 30 right now, although I feel 60, but that's a different story. Henry, I see your question. I will answer. Promise, I will answer near the end once we do Q&A. But continuing on, when we look at 7.5% of inflation, this is the highest level in the last 40 years. So if you're younger than 40, you have not seen 7.5% annualized inflation. Period. I haven't. In fact, when the last time we had 7.5% annualized inflation rate, benchmark rates were approximately 15%. Okay, I can guarantee you that this is going to have an impact on the people. So here's a bitter pill where everyone's gonna have to swallow, including me. I'm a bit sheltered. I'm blessed. I'm fortunate. It doesn't really make too much of a difference, but obviously I do see things from the point of the average person, right? I'm not so secluded and so in the my glass house where I'm so unwilling to see things for what they are. I'm not in that situation. I'm fortunate, and at least I can be sheltered from some of these impacts. But I can tell you, I'm aware that the cost of doing anything has gone increasingly high. Everyone's feeling it. Apparently the economists aren't, because otherwise they would have known inflation isn't transitory. But either way, what the average person in the US, Canada, even Europe, because everyone is seeing higher inflation, but primarily the US, 7.5%. Not only are they getting hit with less purchasing power, not only are they feeling the effects that if they didn't get a 7.5% increase in wage, in salary last year, that means they actually are losing 7.5%. They're making 7.5% less for doing the same amount of work, for getting paid the same amount. That just means it's 7.5% less. It's worth 7.5% less on average. So not only are we getting screwed from that, okay, but as a result, we are now going to feel the impacts of higher rates. So it's a double whammy situation that this infinite credit, infinite money printing, infinite handouts, infinite loose monetary policy has gotten us, the average person, in, who didn't make these decisions, who couldn't make these decisions, right? So while everyone is angry at, everyone has a bone to pick, everyone has grief with, some politician or the other. But, and again, politicians are not angels. But what about the policymakers for, our economy? What about all these people that are projected to be so smart and so genius, so much, such big brain energy there, right? With these people with their PhDs and all their degrees from Harvard and so on and so on. And for what? For what? It just breaks my heart. It breaks my heart that everyone is going to end up really not in a good place if the people that partially had to do with us getting in this situation can't rectify it. If they can't get it right, if they screw up in one direction or the other, and I'll tell you the two directions. If they raise rates too much too quickly, the markets are fucked. Forget the markets for a second. The average person is going to be fucked, because no longer is it going to be just a housing issue. It's like 2008. Um, it's going to be everything. It's going to be an auto loan crisis. It's going to be a supply chain crisis. It's going to be, I mean, if, hopefully Putin and Russia don't attack Ukraine. Otherwise, we'll have a war to contend with too. It's going to be every side the average person is going to be bombarded with. And I'm not trying to fearmonger. I'm just telling you to at least be aware of that chance where if the central banks overshoot rates, it will devastate the average person, and of course markets. On the flip side, if they undershoot the rates, if they go too conservative and don't raise rates enough or quickly enough, what do we have? We have even further runaway inflation. So think about it this way, ladies and gentlemen, and mind my language, you get screwed one way or the other. Do you want it from the front or from behind? How is that okay? How is that okay? And I get it. No one can tell the future, Central banks and Federal Chair Reserve members and Jerome Powell didn't know how things would turn out because obviously it was unprecedented. But I'm willing to give them the benefit of the doubt till 2021, till the middle of 2021. After that, I cannot give them the benefit of the doubt because it was obvious. It was obvious. Like, I just don't understand. It was obvious if these idiots went to their grocery store and instead of getting their driver and their bodyguards and their 10 different assistants to do all this shit for them, if these fuckers just went to the grocery store, if these fuckers just filled up their own gas, it just did any of these things, they would have saw what we all saw. And I've been saying from the middle of 2021 that the Federal Reserve is behind the curve. They are completely incompetent in this. They're inept, and it's going to have an impact. And here we are, 7.5% inflation. We thought 5%. We were like shitting ourselves. Oh my God, we haven't seen inflation as this high in like 20, 25 years. Oh, well, now we haven't seen inflation this high in 40 years. What's going to be next? We haven't seen inflation this high in 60 years? This is the conundrum that we were faced with. And I'm not trying to scare you. I'm not saying this is going to happen, but I'm saying if central banks increase rates too fast, too quickly, we see people get into defaults because maybe they're over leveraged. 99% of people don't understand how economics works, how financial markets work, how monetary policy works. And that's okay. They're not supposed to really. I mean, I'd hope they would, but they're not supposed to. So, hey, why? They're busy wanting to wait for the next Super Bowl. And there's nothing wrong with football, but this is society, right? They're waiting for the next NBA playoffs, or they're waiting for the next Super Bowl, or they're waiting for whatever, right? Like this is how it is. So the people in charge have let us down, and this is the situation we're in. And so to recap, if Federal Reserve increase rate too much, we're fucked. If Federal Reserve doesn't increase rates enough and quickly enough, we're still fucked thanks to inflation. So before you go to sleep tonight, ask yourself, you know what? Which one would you rather take? I don't know. I'll be honest. I have no debts. So I know not everyone's going to agree with me. And obviously I get why. If you have a mortgage or if you have a loan, if you have debts, you're obviously going to feel the impact. So I feel bad in a way because if rates go up too much or too quickly, it's going to hit your wallet. For me, I'm insulated because I didn't. It's not surprising to me, and I'm a lot more old school, and I'm a lot more grounded. So I'll gladly, live like a basic person if that means I don't take money from anyone else, whether it's the bank or whoever, right? So that's me. So for me, it doesn't really matter. I mean, sure, if prices go down, housing prices go down, or car prices go down, I'll gladly welcome that. But that's me. I know not everyone's going to agree, obviously, because if you have real estate and you have your home, you don't want your value of your home go down. Obviously, I get that, right? So, apologies. Long tirade, but I got a lot of thumbs up. So, oil. Fuck, what do we say about oil? It seems like it was not too long ago. It was at $65, $70 a barrel. Here we are at nearly $95 a barrel. It's $93.10 as of last close on futures market. And I can tell you, I wouldn't be surprised if we see 100. I wouldn't be surprised if we see 100. And why is that? Why is that? So, based on historicals, anytime in geographical, geopolitical, any conflict, any war, usually we see higher price oil. Why? Because, for many reasons, but ultimately, the world then shifts its cycles to being more energy dependent. And energy is seen as like its own currency, so to speak. So that currency gets stronger, right? I mean, oil isn't currency, but you get the point. It's highly sought after. Traditional energy. You can't. No matter how much we want, you can't power, missiles with a windmill. You can't power missiles with electricity. You can't power fighter jets, on clean energy, and your run-of-the-mill Tesla batteries taped on each other. You can't do that. So, oil, jet fuel, all these traditional legacy energy sources are key, and they run up, and we've seen that, right? And we see that with oil. So if on the off chance there is a further escalation of conflict between Ukraine and Russia, and God forbid other countries, I mean, could we see $120 oil per barrel? Could we see 150? I mean, fucked if I know. I can tell you it's possible. And I can tell you if that happens, we will never get inflation under control. We will never. Central banks can raise rates, but if we see a doubling in oil like we have, over a span of 2 years, I mean, not even 2 years, because remember, we had fucking negative $40 oil. I still remember that day like it was yesterday. But either way, if we see oil go up, if we see oil go like from 60 to 120, that will further make the case for runaway inflation. Even after a few rate hikes, we'll see inflation remain hot. Because why? Because for CPI, gasoline is part of that measure. Okay. Gold, not much to say. I mean, it's still in this 1800 area. I'm not too stoked on traditional metals. I mean, yeah, you can have a small position here and there, whether it's in terms of an equity, a stock, or an ETF, or even physical. That's up to you. But it's not something that I would buy thinking like, oh, this is such a great hedge. Not really. Not anymore. For the last few years. U.S. dollar currency index I have here at the bottom right. Notice how the U.S. dollars continued to get stronger. A little bit of a dip from the end of January, but still holding up at 96. What does this mean? This is the average of the U.S. dollar compared to the major currencies. Could be, the yen, the yuan, the GBP, the euro, so on and so forth. Right? The major currencies average. Right? And to give you an idea, the last time, further back, it was near these levels was back in July 2020. Okay, so keep an eye on that. If we see oil prices, usually there's an inverse relationship between these two, oil and U.S. dollar. Oil goes up, U.S. dollar gets weaker. U.S. dollar goes up, oil gets weaker. Usually that relationship is true, but during times of war, during times of oil supply crunch, that gets a bit more complex, and it kind of detangles itself. So that correlation isn't always there. Okay, so again, we've run a bit long for this, and I apologize, but hey, this one time, I really, really wanted to take the opportunity to kind of really share what's at stake and my thoughts in a very clear cut, blunt, no holds barred manner. All right. With that said, we'll open up Q&A. I will start with Henry's question here. And he says, sorry to interrupt, but I have seen Rahul's trades. He was putting on some good trades. Are they okay to take? Absolutely, Henry. You are able to take those day trades in the elite membership if you are comfortable with it. Absolutely. Of course, when you're day trading, there's more risk, but obviously a lot more chance of reward. He's done fantastic. So shout out to him for those day trades. And if it's suitable to you, you have the time, you have the ability, absolutely you can take them. All right. Next, we'll close these here and bring up. I had a question from someone here. Well, forwarded to me by Chris, but the question is regards to Target. What are my thoughts around Target in this kind of, whoops, I don't know why I'm typing Target. In and around, how it is as a stock, especially in an interest rate rising environment. So I'll tell you something about Target. Great company, obviously, they've done well, beating earnings, back to back, for the better part of the year. And obviously they issue a little bit of a dividend as well. So yeah, about, what is that, 90 cents per share, right? So I don't know, what's the yield on that? Like a couple percent? 1.7%. Yep, so 1.7% yield. Not bad. What I like more, actually, just because of the powerhouse it is and because their management is so solid, is Walmart. So Walmart is a fantastic company, not going anywhere. They too issue a bit of a dividend here, and that is 55 cents. But the yield, I think, might be a little bit in around the same, 1.6%, 1.63. So similar yield, but I feel what is a better company. Okay, so in my views, if you're gonna think about Target, I would think about Walmart first. Okay, that's my 2 cents. Hopefully that helps if you're watching this. So questions. I have one from here. Daniel, in your opinion, do you see the housing market in Toronto decreasing because of the rising interest rates, making it more difficult for people with a variable mortgage rate to make their monthly payments? Great question. Real estate question. Very interesting. And obviously very pertinent, especially since I'm in and around near Toronto. So, yes, all things equal, we should see a little bit of and I'm not going to say, so yeah, decreasing pricing from what they are right now. Decreasing pricing compared to what they were 2 years ago, no, I don't think we're going to see those levels just yet, because, let's say the Bank of Canada in March raises rates to 25 basis points, and then maybe they do one in the next meeting and so on and so forth. Sure, it will bring it down a little bit, but not too much, right? Not too much, not yet, because people still have a decent amount of equity in their homes. They've been using that home line, their equity, their line of credit, their home line equity credit as a sort of a line of credit that they've just, or the people in the U.S. might be referring to it as a HELOC, right? Whatever you want to call it, the equity they take out of their home and their mortgage to essentially use as a revolving line of credit. People are using that. Most people are using that, and this has been happening for many years. People are what we call house rich, cash poor. Okay, you can remember this saying because it applies now more than ever before. People are home rich, house poor. They have the value of their home, but that's their principal home. Who the fuck cares how much your principal home is worth? My principal home has more than doubled in the last few years, but I don't give a fuck. I don't have a mortgage on it, but I still don't give a fuck. Why? Because what am I going to do? I'm going to sell it and then rent? Am I going to live in a shack? No, I'm going to have to buy another place, which most likely will cost the same, if not more, right? I'm not going to downgrade, so then what's the point, right? You're not net positive. So I really don't give a shit if my principal property goes up and down, 50%, 100%, which sounds so fucking bonkers when it comes to real estate. But ultimately, to answer your question, I think we'll see a little bit of a decrease or less craziness in terms of pricing in the current Toronto area market. And in regards to variable rates, even more so. So from what I can tell, variable rates have been the way to go over the last couple of years. But obviously, in a rising rate environment, I think it will take 2 rate hikes of 25 basis points for people to then want to switch over, where variable rates are not going to be as viable for them. So those people obviously are at risk if they can't port it over to fixed. So that remains to be seen. Delinquencies and defaults, I think we won't be too concerned with those at this point. Um, Question from Zachary. He asked me about Roblox, RBLX, right? This is something I took a trade on by a proxy due to short puts that I got assigned, and then in the day I got assigned. They expired in the money on a Friday. This was a couple weeks back, and then on Monday I sold it, so for a profit. So that worked out for me, but that's pretty much my experience trading Roblox, whatever you want to call it. Obviously, this is a juggernaut of a company in the gaming type of sphere, and I'm not gonna break down what the company does, but ultimately, their recent IPO, massive amount of growth, hype, revenue, and they're a leader in what they kind of do. But obviously, be aware that they have earnings coming up, and we know earnings are very much a coin toss, right? So I feel like it's a good area, especially off the $60 bounce. But who knows? We've seen big swings post earnings in stocks both ways, down and up, right? Think Netflix down 20-25% on earnings. Think, God, I can't even remember Snap up like 50% post earnings. We've seen these kinds of things. So just be very aware. It's not bad from a technical standpoint. From a company valuation standpoint, no, way beyond overvalued. From a long-term hold standpoint, not really my cup of tea. Okay, so hopefully that answered your question. Fiddy asked me, and she says the swear word here, which is PayPal. Do we see it below 100? These are the stats that I had on PayPal for a recent video I did. I'll leave them up just in case you want to refer to them. But do I see it going below 100? I see it going below 100 if markets continue to bleed. It pains me, but yes, this is the kind of thing that we're in for when it comes to a massive tech sell-off plus a market sell-off combined. So yeah, could it go below 100? Yes. Are the chances of it going below 100 if markets recover? Less chance. Less chance of it going lower. So something to consider. It's very much dependent on the market. It's way oversold. I still feel like it's a great candidate for a buy or a hold, okay, at these levels. Moving on, what are my opinions on buying a few Google shares during this pullback? I love this company. Obviously, it's a powerhouse. It's Google, right? I feel like this was a kind of a gift for those that want to hold for the long term to medium term. As far as the split thing, look, back in the olden days, it didn't really matter if a split was happening. It wasn't seen as good or bad per se. But obviously over the last year or so with retail, anytime a stock is splitting, it runs up before the split and after the split. So obviously things have changed, but I think that's stupid. I don't see why it would split. Yeah, it just makes the stock more approachable, more easier for retail to get in. And in this case, this is a fantastic company. So I think it's worth having some regardless of the split or not, right? So yeah, I think it's a great company. I would definitely consider buying some. I would just be aware that, of course, it's selling off just like everything else with the market. So Friday was a big red day in the market, big sell-off. Here we are, Google selling off too. So it gets very interesting here around the 2,600 level, and if it goes lower to 2,500 level, I would, if you have the large enough account, maybe I would, see if it's possible to scale in. But even now, I think you can't go wrong with this below the 200-day moving average for a long-term hold. Okay, my thoughts on that. Hopefully that's helpful. Question from Lloyd. A lot of talk about potential inverted yield curve. What's your perspective? How it would affect the market? Seems to be a big concern. So here's the thing. The yield curve, I'm trying to bring it up. Let's see if I can bring it up. So the yield curve refers to, again, there's various interpretation. 2-year Treasury bond. Okay. Let me add 10-year Treasury bond yield. So, yeah, not the greatest, not what I was going for. But here we go. So, in yellow or orange, sorry, we have the 10-year in the in this what's it called? In the candles. Sorry, blanking out here. In the candles, we have the 2-year. So, the yield curve is something where we see the back end or the front end. In this case, if we see a 2-year increase go above a 10-year, right? Or if we see a 10-year vice versa going lower than a 2-year, right? So this is kind of the concerns. I don't think it's something that the market is too concerned about yet. Sure, it's factored in before, but every time people have panicked about the yield curve, again, this chart isn't, it's not meant to be interpreted this way. I'm just bringing it up here, just to give you a slight idea. But I feel like right now it's not too big of a deal, frankly speaking. I think the market is a lot more concerned with broader interest rates, broader yields as a whole, as opposed to yield curve. I know before it was a different story where the yield curve was everything. Now, if the bond yields start going up, whether it's a 2-year, 10-year, 20-year, whatever, if they start going up, the market is cognizant and a bit sensitive to that. Okay, so hopefully that kind of gives you a little bit of idea, Lloyd. I know it's not kind of the answer you were looking for in terms of, oh, this is going to happen if yield curve inverts. It's not that simple. We've been here before where this yield curve inverting worry was all that everyone talked about, and then nothing happened. Nothing came of it. And this is most things. And guess what? Hopefully, fingers crossed, this whole Russia-Ukraine thing, going back to that, hopefully this conflict is, nothing. Hopefully it's something it's a wall of worry, as I say, that we won't need to deal with, right? That's just my hope, and I hope we're all kind of in that kind of boat, because no one really wants, war and conflict and further problems for the world and as for humanity after everything that's happened the last 2 years. Oh man, give me a break, right? Yeah, so Putin, please pack your bags, go back home. All right, that's my 2 cents on that. No more questions I see coming in, so I hope, you guys haven't fallen asleep. And, seriously though, for big thanks to everyone that came on. Appreciate it. Great questions. I know I went a bit long in terms of the first little bit, but I hope it gave you a look into my my brain, my mind, as to how I feel and my thoughts around the state of the economy in terms of the U.S., but even globally, right? In terms of policymakers, in terms of these people that really, frankly, are not that competent and are not that smart, are not that well versed as we may think, or as they may have us believe. So be aware of that. And again, I say this with no bias whatsoever. I don't care if this person or these people are Republicans or Democrats or libertarians or conservatives or liberals. I don't have time or patience for that kind of stuff. I care about, the reality. I care about things that are objective and rooted in reality. And guess what? Based on everything that's occurred, that tells me that, there's plenty of individuals, whether they're politicians, policymakers, economists, so on and so forth, that really may not, be as smart as we once thought. So, hey, that's my thoughts on this. Hopefully, you appreciated it. Please like, subscribe. Honestly, if there's one thing I can tell you guys, whether it's all our social media, whether it's Instagram, Twitter, so on and so forth, YouTube, whether it's our YouTube videos, whatever it is, please do your best to engage with us, to like our content, share it, because I don't know what it is, but the last year, it's it's been pretty rough. I don't know what's going on in terms of engagement, in terms of our content either being censored or you know not being shown. There's something going on, and it's been going on for the last year. But your support, your comments, your likes, sharing, everything goes a long way. That much I can promise you, in really getting us back to where we were in terms of an engagement standpoint, so that more people can be aware of what we do and more people can hopefully benefit from what we do. Because really, that's all it is about. It's about sharing mine and the team's experiences and our thoughts and our moves, our decisions in markets with you all, so that hopefully it benefits you, and not just from a monetary standpoint. Obviously, we want you to do well, make money, but from intellectual standpoint, from a perspective standpoint, from a mindset standpoint. So please do that. That's my one request for everyone. Thank you again for being on with me for the full hour. It's much appreciated. And be well, be safe, have a great rest of the weekend, and hopefully there's no war or conflict in the near future or ever in our lifetimes. And we can get back to normal. We can hopefully, fingers crossed, the rate hikes and the kind of things that the central bankers are doing now, which is a little bit late, but hey, better late than never. Hopefully that kind of brings the economy back on track, brings inflation back down, so yeah, have good spirits, hope for the best, but also be aware of what's happening, be open-minded and prepare, right? That's all we can do. All right, much love. Thank you so much, everyone. Take care. Ciao.